Hey historians, it's Mrs. Tyler, and we are talking about the stock market. So we have a new set of notes today in our new Unit 5 notes packet. This is an activity for our stock market simulation. We're going to talk about what is stock. We're going to talk about why would somebody want to buy stock, and do you think you will speculate in the stock market someday? Okay, so stock is a share of ownership in a corporation. The more shares of stock you buy for one corporation, the larger percent of ownership you have in that company. You share in the success and failure of that company. So in your notes, please write down the word here and then fill in the blank. Okay? A stockholder is a person who owns stock in a corporation. Okay? A stockbroker is a person whose job it is to help people who have money that they want to invest in the stock market to buy and sell stocks. Okay, when a corporation decides to sell shares of their business in stocks, they submit something called a prospectus. A prospectus is a statement that describes the business and what prospective buyers and investors are going to use if they want to decide if they want to invest in that company, if they're interested in investing in that company. Banks can give you a line of credit. This is a loan. When you borrow money from the bank, you pay them interest in return on that loan. For example, okay, if you borrow $1,000, you take out a loan from the bank for $1,000 and it has 10% interest, you will not just repay the $1,000 back to the bank, but you also will pay an additional $100 over time for the opportunity to borrow that money. And also, banks give customers interest for putting their money in their banks. So, banks basically pay you to let them lend out your money. When you put your money in the bank, it doesn't just sit there waiting for you to come back for it. It gets put to use. Okay, so if you put $1,000 into a bank account with 5% interest rate, after a year, if you did not take money out of the bank, you will have an additional $50 in your bank account because the bank will be paying you essentially to let them use your money. In the late 1910s and early 1920s, a technique that was often used was called buying on the margin. People would go get a loan from their bank, and they would use that loan, which is not their own money, but the bank's money, to buy shares of stock. This loan would still be required to be paid back and with interest. So it's risky because if you go and borrow a loan, take out credit at a bank, and you go and use that money to invest in the stock market, when the bank needs their money back and you're supposed to pay it back, if the value of the stock has gone down, then you're not going to get all that money back. And then you're going to have to come up with the remaining amount to repay the bank plus the interest that it costs for you to have that loan. The world's largest stock exchange is the New York Stock Exchange. It's located on Wall Street in Lower Manhattan in New York City. Just to give you an idea, the New York Stock Exchange traded on average in 2013 a value of $169 billion every day. So let's say that you wanted to do some investing in the stock market. Let's say you purchased 20 shares of Apple stock back when it was $10 a share and $30 of Google stock when it was $10 a share. You're investing $500 of your own money into the stock market. Let's say that when you check back, the price for the Apple stock has gone up to $20 a share, and the price for the Google stock has gone up to 30. Okay, you still own the 20 shares, you still own the 30 shares, so now you just have to figure out how much your value is now. Okay, the total that you could get if you sold all of your stock right there would be, okay? Now, you cannot say that you made $1,300 because 500 of that was your money already. So you have to subtract that original $500 you spent to invest in the stock market. Okay, so the same idea here. 400 minus 200, you made $200 on your Apple stock. 900 minus 300 is another 600. Okay, you made $600. These are positives. You're making a profit. Okay, so then you end up making $800 off the stock market. So, I'm going to skip ahead. In class today, you have 6 of these on page 4 of our notes packet. Opening day is what we're starting with today. You're going to invest $500 in stocks, not real money, obviously. So we're just going to be checking the value of stocks over the next few days. You need to invest $500 total, and they have to be in purchases in increments of 10 shares at a time. So you could choose to put all, that means you have 50 shares to buy because they all start at $10 a share. If you, let's say you wanted to put all of the shares, all of your $500 into one company, so you'd buy 50 shares and that would equal $500. Or you could do, it's going to always equal 500. So you could do 10 shares here, let's say 20 shares in Durant and 20 shares there. That's 50. Or you could do 10, 10, 10, 10, 10. Okay? Any way you do it, it has to be in increments of 10, and it has to equal $500, so you have 50 shares. Okay? I'm going to go through the prospectus information for all of these companies. Okay, you're going to have to decide which companies you want to make. I will leave this on for a second. You can give it a read. Decide which of these companies are going to be better investments for you. Kroger Foods, Radio Corporation, they build electronics. Mammoth Oil, they have oil fields out in California. They want to expand into Wyoming. National Bank of Gotham. Durant Motors. Midland Power. They bring electricity. Basically, it's an electricity company, power company. Kansas Pacific Railroad. And TELE-TONE. Okay, these are the companies you can choose from. You need to go ahead and fill in your stocks. Okay. You can choose the ones that I have filled in here, or you could choose your own version. Okay? But it has to equal $500. What you are going to make sure that you do, whatever you have put in column B for your opening day is going to be moved to column B for every single day, for every single table. Okay? So make sure that you have that. Check your neighbor's charts. Did they buy $500 in shares? Did they buy at least 10 shares of whichever companies they chose? And did they fill in column B on all 6 charts in pen? That will have us set up so that when we come to class tomorrow, we will check the new value and do our stock market math to see if we have made a profit or a loss for each of those. Okay? Thanks for watching.